Most people believe banks take deposits and then lend that money out to borrowers. It sounds simple, logical, almost mechanical. You deposit your paycheck. The bank stores it. Someone else applies for a loan, and the bank transfers a portion of that stored money to them. End of story. But that is not how modern banking actually works. In reality, when a bank issues a loan, it does not move pre-existing money from one account to another. It creates new money, digitally, instantly, through accounting entries. And once you understand that mechanism, the way you see the economy begins to shift. Because money, in today's system, is not primarily created by printing physical cash. It is created through credit, through debt, through balance sheets expanding. To understand this, you have to stop thinking of a bank as a vault. A modern bank is not a storage box filled with cash waiting to be handed out. It is a financial institution operating on a balance sheet. On one side of that balance sheet are assets. On the other side are liabilities. When you deposit $1,000 into your bank account, the bank records that deposit as a liability. From the bank's perspective, it owes you that money. Your deposit is its obligation. Now consider what happens when the bank approves a $10,000 loan. The common assumption is that the bank takes $10,000 from someone else's deposit and hands it to the borrower. But that is not what happens. Instead, the bank creates a new asset on its books, the loan agreement. The borrower now owes the bank $10,000 plus interest. At the exact same moment, the bank creates a new liability, a $10,000 deposit in the borrower's account. That deposit did not previously exist. No other customer's account was reduced. No vault was opened. Money entered the system because debt was created. This is the core engine of modern money creation. If that feels abstract, think of it this way. Imagine the banking system as a scoreboard, not a pile of cash. When a loan is approved, the numbers on the scoreboard increase. The borrower's account goes up. The bank's loan asset increases. The system expands. The money is not moving from somewhere else. The numbers are being added. Now imagine that borrower spends the $10,000. Perhaps they pay a contractor, or purchase equipment, or invest in inventory. The recipient deposits that money into their own bank. That second bank now records a new deposit liability. And because it now has additional reserves and stable conditions, it can issue new loans of its own. Those loans create new deposits elsewhere. The process repeats. Through layers of lending and redepositing, purchasing power expands across the system. This is often described as fractional reserve banking, but the terminology matters less than the mechanism. Commercial banks expand the money supply by issuing loans. When loans are repaid, the opposite occurs. The asset on the bank's books shrinks. The corresponding deposit disappears. Money is effectively destroyed through repayment, so the money supply is not fixed. It breathes. It expands when credit grows. It contracts when debt is reduced. Now consider the broader system. If commercial banks create money through lending, who influences how aggressively they lend? In the United States, that responsibility largely falls to the Federal Reserve. The Federal Reserve does not directly approve your mortgage or business loan. Instead, it influences the broader financial environment by setting benchmark interest rates and managing liquidity. Interest rates are essentially the price of borrowing money. When rates are low, borrowing becomes cheaper. Businesses are more likely to finance expansion. Investors are more comfortable leveraging assets. Consumers are more willing to take on mortgages and loans. Credit expands faster. When rates rise, borrowing becomes more expensive. Projects that once looked profitable may no longer make sense. Risk-taking decreases. Expansion slows. By adjusting interest rates and providing or withdrawing liquidity from the system, the central bank influences the pace of credit creation. It also serves as a stabilizing force during periods of stress. If banks face liquidity shortages, it can provide short-term funding to prevent cascading failures. But even the central bank does not create most of the money circulating in the economy. Commercial bank lending does. This has powerful implications. If money is created primarily through debt, then access to credit determines who can expand first. A company that borrows to acquire productive assets, technology, equipment, property, intellectual capital, can use that borrowed money to generate future cash flow. Debt becomes a lever. If managed properly, it amplifies growth. But if borrowing is used primarily for consumption, lifestyle upgrades, depreciating goods, short-term gratification, the outcome is different. The mechanism is identical. The result is not. The banking system itself does not decide whether debt is productive or destructive. It evaluates risk, collateral, and expected return. The responsibility for how borrowed capital is used lies with the borrower. Understanding this structure changes how you interpret financial decisions. Instead of seeing debt as inherently negative, you begin to evaluate its purpose. Is it funding income-generating capacity, or is it funding temporary consumption? That distinction compounds over time. History shows what happens when credit expands without discipline. During periods of optimism, lending standards may loosen. Asset prices may rise rapidly. Leverage increases because rising prices appear to justify more borrowing. But when asset values decline or income expectations fall short, highly leveraged positions become fragile. In 2008, institutions such as Lehman Brothers collapsed under excessive leverage and deteriorating asset quality. Confidence evaporated. Interbank lending slowed. Credit markets tightened sharply. The same mechanism that fueled expansion amplified the contraction. It is important to recognize that the system itself is not inherently unstable. It is sensitive to incentives and risk management. When underwriting standards are strong and leverage remains sustainable, credit expansion supports growth. When risk is mispriced and leverage exceeds productive capacity, instability emerges. So what does this mean for you? It means the modern financial system is not built on stacks of stored cash waiting to be distributed. It is built on expanding and contracting credit relationships. Your bank balance represents a liability on a bank's balance sheet. Your loan represents an asset on theirs. The economy grows when balance sheets expand. It slows when they shrink. This does not mean the system is designed against individuals. It means it operates according to structural rules. Money flows toward those who can access and deploy credit effectively. Understanding that money is created through debt does not require fear. It requires awareness. Because once you recognize how the mechanism works, you start asking more precise questions. Who is borrowing heavily right now? Are loans funding productive investment or speculative excess? Are interest rates encouraging sustainable growth or short-term risk-taking? Where is leverage building quietly beneath the surface? These questions influence asset prices, inflation trends, business cycles, and long-term wealth outcomes. The banking system is not moral or immoral. It is a framework. It expands through confidence. It contracts through fear. It rewards disciplined participants, and it exposes reckless ones. Once you see that money is largely the byproduct of credit creation, one final realization becomes clear. The system is not designed to automatically generate financial security. It is designed to facilitate expansion. Where you position yourself within that expansion determines your trajectory. Because earning money inside the system is one thing, understanding how the system creates money is another. And in the next episode, we examine how inflation quietly reshapes purchasing power, and why earning more does not always mean getting ahead.